What if I told you the world's richest investor didn't get there by chasing hot stocks or gambling on risky bets? What if his secret wasn't genius IQ, insider knowledge, or even luck, but something far simpler, and something you could start using today? This is the story of Warren Buffett, a guy who grew up in a small Nebraska town, started buying stocks as a teenager, and went on to amass nearly $100 billion. But here's what most people miss. Buffett didn't win because he was smarter than everyone else. He won because he followed a set of principles so simple they almost sound boring until you see the results. In this video, we're breaking down exactly how he did it. Not just the what, but the why behind his decisions. You'll learn why patience isn't just a virtue in investing, it's a weapon. Why playing defense can make you richer than offense. And why thinking like a business owner, even if you're only buying one share, can completely change your financial future. From Omaha to Oracle of investing. So where does Warren Buffett's story really begin? Not in a boardroom or on Wall Street, but in the heartland of America, Omaha, Nebraska. Born in 1930, Buffett wasn't exactly handed a golden ticket to success. What he did have, though, was something far more valuable: a relentless curiosity about money and an almost unnatural knack for numbers. Even as a kid, Buffett had this entrepreneurial spark that most of us only dream of having. By age 6, yes, 6, he was buying packs of gum and reselling them door to door for a profit. A few years later, he was running his own paper route, managing multiple routes at once and filing taxes on his earnings by the time he was 13. 13! Most of us were still trying to figure out how to get out of doing chores at that age. But here's the pivotal moment, the one that would set him on the path to becoming the Oracle of Omaha. At just 11 years old, Buffett made his first stock investment. He bought shares of City Service Preferred, a company you've probably never heard of, for $38 each. Now imagine being a kid sitting there watching the ticker tape roll, dreaming of striking it rich. Sounds exciting, right? Well, reality hit hard. The stock dropped to 27. Ouch. For anyone else, that might have been the end of their investing career before it even started, but not Buffett. Instead of panicking, he doubled down. When the price eventually rebounded to 40, he sold, only to watch it soar past $200 shortly after. Another gut punch, but also another lesson learned. That experience taught Buffett two things that would define his entire career: patience and perspective. He realized quick wins aren't everything, and sometimes the best move is to sit tight and let time work in your favor. It's a philosophy he'd carry with him for life, earning billions by playing the long game while everyone else chased overnight riches. But Buffett didn't stop there. As a teenager, he devoured financial books, studied annual reports like they were novels, and soaked up every bit of knowledge he could find. He wasn't just learning how to pick stocks, he was learning how businesses worked, who made money, why they made it, and how to spot hidden gems others overlooked. This obsession with understanding the fundamentals became the cornerstone of his strategy, and it all started right there in Omaha. So how did this small-town boy take those early lessons and turn them into a multi-billion-dollar empire? And more importantly, what can you learn from his approach to investing without needing billions to start? Stick around, because we're about to break it all down step by step. Moving on to the power of patience. Buffett famously said, "The stock market is designed to transfer money from the active to the patient." And if there's one principle that defines his success, it's this: patience isn't just a virtue, it's a superpower. While most investors are busy chasing quick wins, jumping in and out of stocks like they're playing a game of hot potato, Buffett takes a completely different approach. He invests in quality companies, holds onto them for years, sometimes decades, and lets the magic of compounding do the heavy lifting. It sounds simple, but as you'll see, simple doesn't mean easy. Picture two investors, Bob and Alice. Bob is the type who can't sit still. Every time he hears about a hot stock or sees some flashy headlines, he jumps ship, buying low, selling lower, and constantly second-guessing himself. Alice, on the other hand, follows Buffett's playbook. She picks solid companies, buys when prices are reasonable, and then waits. Years go by, and while Bob's portfolio looks like a roller coaster ride full of losses and missed opportunities, Alice's steady approach has paid off big time. Her investments have grown exponentially, proving that slow and steady really does win the race. Now let's look at John and Sarah. John spends his days glued to stock charts, trying to time the market perfectly. He buys high, sells low, and lets fear and greed dictate his moves. Sarah? She stays calm. When markets dip, she doesn't panic. When everyone else is piling into trendy stocks, she sticks to her plan. Over time, Sarah's discipline pays off. Her portfolio grows steadily, while John's erratic behaviour leaves him spinning his wheels. The lesson: markets will always fluctuate, but emotional decisions only lead to regret. This philosophy isn't just theoretical, it's how Buffett built his empire. Take Coca-Cola, for example. He first invested in 1988 and hasn't looked back since. Sure, there were ups and downs along the way, but Buffett didn't flinch. Decades later, his patience has been rewarded handsomely, with Coca-Cola's value and dividends skyrocketing. That's the power of buy and hold investing, staying committed to great businesses through thick and thin. So why does this matter for you? Because the same principles apply no matter how much money you're starting with. Patience beats panic every single time. By focusing on long-term growth instead of short-term gains, you position yourself to benefit from the same forces that made Buffett billions. Think about it. Would you rather be Bob or Alice? The choice is yours. Next up, the ultimate never lose money rule guide. Now let's dive into the secret formula that made Warren Buffett the world's richest investor. And it all starts with two simple rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. At first glance, these rules might sound obvious, or even a little funny. But here's the kicker. Most investors ignore them. They get lured in by flashy promises, overhyped trends, and dreams of quick riches, only to end up losing big when things go south. Buffett's genius lies in how he applies these rules. It's not about avoiding risk altogether, it's about managing it. He focuses on protecting his capital first, and always looks for a margin of safety, a cushion that shields him from disaster if things don't go as planned. Imagine two investors, Jack and Emily. Both are eyeing a trendy tech startup promising astronomical growth. Jack jumps in head first, dazzled by slick marketing and sky-high projections. Emily, on the other hand, takes her time. She digs deep into the company's financials, evaluates its market potential, and asks herself the million-dollar question: what if this goes wrong? Fast forward a year, and the startup starts to struggle. It turns out their promises were too good to be true. While Jack scrambles to cut his losses, Emily's careful approach keeps her portfolio safe. Her focus on minimizing risks saves her from disaster, proving once again that Buffett's advice isn't just smart, it's essential. Let's take another example, one straight out of Buffett's playbook. Back in the early 1960s, American Express AMEX was in trouble. A scandal involving one of its subsidiaries rocked the company, sending its stock price plummeting. Most investors panicked and sold off their shares. But Buffett, he saw opportunity where others saw chaos. He knew Amex's brand and core business were still strong. It was just facing a temporary setback. Buffett stuck to his mantra: protect your capital, but don't miss a chance to buy quality at a discount. He invested heavily in AMEX during the downturn, knowing the company had a solid foundation. Fast forward a few years, and AMEX bounced back stronger than ever. Buffett's bet paid off handsomely, turning his investment into billions over time. This wasn't luck, it was discipline in action. So what's the takeaway here? Buffett's emphasis on capital preservation and risk management is more than just a rule, it's a mindset. By prioritizing downside protection, doing your homework, and staying calm when others panic, you set yourself up for long-term success. Investing isn't about hitting home runs every time. It's about avoiding strikeouts and letting compounding work its magic. If this video helped you understand why Buffett's principles stand the test of time, drop a comment below saying video, and I'll keep breaking down strategies from the best minds in investing. Because let's face it, if it worked for Buffett, it can work for us too. Why continuous learning is Buffett's secret weapon. Now let's talk about the power of knowledge, a cornerstone of Warren Buffett's success. Charlie Munger, Buffett's right-hand man, once said, "Spend each day trying to be a little wiser than you were when you woke up." This philosophy of continuous learning and self-improvement forms the foundation of Buffett's approach to investing and life itself. Here's the thing. Buffett doesn't rely on gut feelings, hot tips, or flashy trends. Instead, he dives deep into financial statements, annual reports, and the fundamentals of companies. While others are glued to their screens chasing headlines or scrolling through social media, Buffett stays laser-focused on what truly matters, understanding the businesses he invests in. His decisions aren't driven by hype, but by thorough analysis and sound judgment. Buffett attributes much of his success to his willingness to learn from others. He reads voraciously, books, newspapers, and reports, constantly seeking wisdom from those who came before him. For Buffett, knowledge isn't just power, it's the ultimate competitive advantage. Take See's Candies, for instance. In 1972, Buffett acquired See's for $25 million. At the time, some investors questioned why he'd put money into a candy company, but Buffett saw something they missed: a strong brand and loyal customers. Over the years, See's has generated consistent profits for Berkshire Hathaway, proving that patience and insight pay off big time. Buffett's commitment to knowledge even extends to areas outside his comfort zone. During the dot-com bubble of the late 1990s, while many investors chased risky tech stocks, Buffett stayed disciplined. He avoided speculative fads and stuck to companies with solid business models. A decade later, he invested in IBM, a move that initially faced skepticism, but ultimately demonstrated his ability to adapt and thrive. How Buffett finds hidden gems in the market. Let's shift gears and talk about another key ingredient in Buffett's secret formula: value investing. He famously said, "Price is what you pay, value is what you get." This simple yet profound mantra captures his philosophy of buying companies at a discount to their intrinsic value, ensuring a margin of safety. Think of Buffett as a savvy shopper hunting for bargains in a clearance sale. He's not swayed by flashy stocks or speculative manias. Instead, he zeroes in on quality companies with durable competitive advantages, businesses that can weather storms and thrive over time. Consider Buffett's investment in IBM during the early 2010s. Despite challenges in adapting to the rapidly changing tech landscape, Buffett recognized IBM's ability to generate consistent cash flows and deliver shareholder value over the long term. While others dismissed IBM as outdated, Buffett saw an opportunity to acquire a quality business at an attractive valuation. His belief paid off as IBM's stock rebounded, showcasing the power of value investing. To make this clearer, imagine Buffett investing in XYZ Corporation, a fictional manufacturing company. In the early 2000s, XYZ faced industry-wide challenges and management missteps, causing its stock price to plummet. While most investors fled, Buffett conducted a thorough analysis of the company's intrinsic value. He recognized its extensive portfolio of assets, factories, machinery, intellectual property, and remained confident in its long-term potential. As time passed, XYZ implemented strategic initiatives to streamline operations and refocus on its core strengths. Under new leadership, the company returned to profitability, rewarding Buffett's patience with substantial returns. This fictional scenario underscores Buffett's unwavering commitment to value investing, buying quality companies at discounted prices, and staying patient. Enduring legacy with the long-term mindset in investing. Why Buffett thinks in decades, not days. Finally, let's talk about what truly sets Buffett apart: his long-term mindset. He famously declared, "Our favorite holding period is forever." This statement epitomizes his belief in the power of patience and conviction. While many investors are consumed by short-term trading, Buffett sees stocks as ownership stakes in real businesses. He views each investment as a partnership, focusing on steady growth and compounding returns over time. Take Apple Inc., for instance. In 2016, Berkshire Hathaway began buying shares of Apple, recognizing its strong brand, loyal customer base, and innovative product pipeline. Despite concerns about slowing iPhone sales, Buffett remained confident in Apple's ability to deliver long-term value. Fast forward to today, and Apple's stock price has soared, reaffirming the wisdom of Buffett's patient approach. Imagine a company called Future Tech Innovations, a leader in cutting-edge technology solutions. Despite temporary setbacks, Buffett takes a long-term view, believing in its potential to revolutionize industries. He patiently accumulates shares, confident in the company's ability to innovate and adapt. Over time, Future Tech unveils groundbreaking products, driving its stock price higher and rewarding Buffett's patience. Buffett's long-term mindset is a testament to the power of patience and discipline. By focusing on the fundamentals and ignoring short-term noise, he has achieved unparalleled success over decades. As we unravel the mysteries behind his career, one thing becomes clear. In the game of investing, a long-term mindset is the ultimate edge. Who is Warren Buffett beyond the numbers? Before we wrap up, let's take a moment to appreciate Warren Buffett as a person. Despite his immense wealth, he remains humble, down-to-earth, and approachable. He lives in the same modest house in Omaha, Nebraska, that he purchased decades ago, a testament to his values of simplicity and integrity. Buffett is known for his charm and sense of humor, often engaging in casual conversations with shareholders and admirers. He's not just a billionaire, he's a teacher, sharing his wisdom with millions around the world. Beyond investing, Buffett's philanthropic endeavors have left an indelible mark on society. Through the Giving Pledge, he has pledged to donate the majority of his wealth to charitable causes, addressing issues like poverty, education, and healthcare. His generosity exemplifies his belief that wealth should be used to improve the lives of others. In summary, Warren Buffett stands as a beacon of integrity, wisdom, and generosity. His principles of value investing, patience, and long-term thinking continue to inspire generations of investors. As we reflect on his legacy, it's clear that his impact extends far beyond the financial world. Your next steps after learning from Buffett. And there you have it, the secret formula that made Warren Buffett the world's richest investor. From his humble beginnings in Omaha to his legendary status as the Oracle of Omaha, Buffett's journey is a testament to the power of patience, discipline, and sound investing principles. So now that we've unraveled the mysteries behind Buffett's success, it's time for you to take action. Ask yourself, how can I apply Buffett's timeless principles to my own investing journey? What steps can I take to cultivate patience, discipline, and a long-term mindset? Remember, the journey to financial greatness begins with a single step, and today you've taken that step by diving into the world of Warren Buffett. If you found this video helpful, drop a comment below saying video, and I'll keep creating content like this. Don't forget to like, share, and subscribe to our channel. And if you're curious about other rich investors and their stories, check out the video I recommend next. It might just change your perspective on wealth building. Thanks for watching, and until next time, stay curious, stay disciplined, and keep learning.